Good morning or afternoon, everyone, and welcome to the JIB Audit Impact of the new 2015 AAPL Model Form JOA webinar presented by Hine and Associates. I'm Carrie Baines, your moderator and webinar organizer today. Before we start, let's take a moment to cover a few housekeeping items. All audio lines are muted. Please use our chat feature to ask questions. We will save time at the end for Q&A. This webinar is being recorded, and a copy of the webinar presentation and recording will be sent out to all registrants later today. Your active participation is important throughout the session. In order to receive CPE credit for this session, you will need to be connected for a minimum of 50 minutes and must answer 75% of all of the polling questions included throughout the presentation. Immediately following this webinar, you will be directed to a survey page where you can leave comments. Please check your inbox later today for a follow-up email that contains an evaluation form that must be submitted in order to receive your CPE certificate for the course. Our presenter today is Deanna Dwell, Managing Consultant Business Advisory Services in our Denver office. Deanna has more than 18 years of oil and gas industry experience and currently serves on the Business Advisory Services team at Hine. Her focus is in managing operational accounting, non-attest engagements for E&P companies. Her responsibilities include managing JV audit engagements for non-operators, having an interest in operations, and advising her clients on audit requirements and outcomes. She also manages consulting engagements for clients who perform operations to provide essential guidance in accurately billing and paying non-operated partners in the JOA. As a result of her active engagements in the oil and gas industry at the firm and her years of diverse professional experience, she understands the inherent challenges for companies in accounting. Due to her qualifications and experience, she holds a designation as a Chartered Global Management Accountant through the AICPA. Thank you for attending today, and I would now like to introduce Deanna.
Good morning and welcome. Thank you for taking the time to join us this morning for the webinar. Before we jump into the objectives, I'd like you to consider a time when you found some extra money, perhaps as a result of spring cleaning or looking in your pockets and your jacket, or maybe you just got a check in the mail. What did you do with that money that you didn't know that you had? And since you had it, and now it is available to spend, how did that make you feel? And then how does that relate to what we're discussing today in the business world? Wouldn't it be nice to find some extra money for your business? So today we're going to touch upon how you might be able to find this extra money and how it might benefit your business in the long run, and why the contracts you have in place and having knowledge about how those apply to your business and your ability to recover costs for your company are top of mind in order to find that extra money and make a difference for your business. So we'll jump into the first objective, and that is on the AAPL new 2015 model form. Keep in mind that the AAPL is the Landman Association, and COPAS is the Council of Petroleum Accountants Society. So AAPL is to Landman as COPAS is to accountants. Both organizations create, update, and formulate guidance on the documents they publish that help serve the oil and gas industry. The mission of the AAPL is to promote the highest standards of performance for all land professionals, to advance their stature, and to encourage sound and ethical stewardship of energy and mineral resources. As you can tell by this slide, there are over 18,000 landmen and 44 affiliate local associations in the U.S. I also put the logos over the years just to give you some idea of where this association has been and kind of where it's going. You can tell by the center logo, it was kind of a world focus. They have the world map there, but if you think about it, and maybe the transition to the new AAPL America's Landman logo is really a result of the fact that the United States is unique in that we're the only country in the world to have the issues of land ownership. No other country in the world has the issues that we have in our industry. So back in February, I helped co-present in a series that the AAPL put on. It was Landman 2.0. And this series was a look at the relationship between operators and non-operators through the lens of the Joint Operating Agreement, old and new, and explored the new AAPL Model Operating Agreement, how it might affect the new challenges being faced by the industry. It specifically looked at the rights and remedies of non-operators and capital providers in the joint operations context, gas balancing, how rework and recompletion decisions affect unit participation, and how to close out a unit and limit future liability. I suggest getting in contact with the AAPL if you have an interest in learning more about this series, or if you have other interests in the land area, just because the AAPL really does a good job putting on programming and information in this area. And, you know, I think many companies have landmen that are members, but also as accountants, I think it's also beneficial and helpful to get that perspective.
Okay, so our first polling question this morning: how many affiliate local associations of the AAPL are there in the U.S.? Less than 30, between 35 and 40, over 40. Okay, I think we'll close the poll. So it looks like the overwhelming response was over 40.
That's correct. So if you recall, there are 44 affiliate local associations in the U.S. And a little humor break here, since we are talking about a legal form, and I am an accountant, let's keep that in mind, that accountants and lawyers kind of come at things in a little bit different manner. So we'll move along with here and keeping that in mind. I did attend a seminar put on by Davis, Grahams, and Stubbs back in 2016, late 2016. They're a full-service business law firm serving clients for more than 100 years, and they serve clients nationally and internationally, with one of many focuses being on the energy industry. So in that seminar, in that little presentation, I found it to be very helpful, and I'm putting a link here on this slide. Hopefully you get a chance to go there, because they do a good job of highlighting what the new 2015 model form, how that changes the older form, both the 1989 and the 1989H. Now, specifically the H was developed for horizontal drilling, and that was put out by the AAPL back in December of 2013. Now that they have the new 2015 form, even though it wasn't put out till 2016, it was voted and approved back in 2015. And so when it was presented by Davis, Grahams, and Stubbs, they talked about the 2016 AAPL Model Form Joint Operating Agreement. That's the title. However, it is the 2015 model form, just so that there's no confusion there when you do go out there and take a look at it.
Okay, and time for our second polling question. What year did the AAPL rewrite the JOA? 2005, 2012, 2015, or 2017. Okay, we're getting ready to close this poll. Again, overwhelming response 2015.
All right, so everyone's listening. That's good news. And we'll move on to kind of changes of notable changes that I took away from that presentation and want to share with you today with respect to the accounting procedure. And basically, the accounting procedure is unchanged because that's the COPAS document. COPAS is the one that publishes that document. It's the 2005 accounting procedure that should be what you're using today. Anything prior to 2005 from a onshore perspective is no longer available for sale by COPAS. These are copyright documents. So it's important that your landmen are aware. If you talk to landmen or people in your organization, they need to be using the one that is available through COPAS. They should not be using the old forms. Those are retired and no longer available. It's a copyright issue. So that's just something I want to bring up and make sure everybody takes that away with them. Also, there's an offshore publication that was back in April of 2012. So that is the proper offshore publication that should be used. That's the exhibit for the joint operating agreement on the offshore side. So 2005 and 2012. The AAPL, what I understand from the Association of Landmen is that they don't really retire their old forms like we do. So I believe, and you'd have to double check with them, but I believe that they'll continue to have those other forms available. However, the new one is really going to be a form that's going to help you address current issues with respect to horizontal drilling. And then again, we'll talk about the things of note here. Exhibit A requirements for that new model form. There's a new mechanism in place that is there to amend Exhibit A, which changes ownership. As many of you know, there's been a tremendous amount of activity in our industry over the past couple of years with companies going bankrupt and companies selling assets, buying assets, that sort of thing. So the reason the AAPL decided they needed to make this change is because of all of the activity that occurs, and it's really important to keep this Exhibit A up to date. So take a look at that requirement because that mechanism for amending Exhibit A is there for a reason, and I think it's a really good reason. On the end of the operatorship, you know, we've seen in our own practice that there have been contract operators out there. There's also been some recent litigation in terms of the exculpatory clause. Now, I'm not going to speak to that only because I'm not a lawyer and I don't really have the insight there, but DG&S or Davis, Grahams and Subs does talk about that and some of the case law around the exculpatory clause, and that did change in the new form. Also, it addresses non-owning operator types because in the past, in our industry, it wasn't foreseen that, you know, somebody that was not an owner in that well would be operating that well. Well, things have changed, and our industry is seeing more and more contract-type operations occurring because those that are involved in the well maybe don't have the capacity or ability to operate the well. And the old model forms never addressed this aspect. So the new model form does speak to an affiliate. So what I mean by an affiliate is somebody that is an owner, but it's an affiliate company to that owner that is the operator. And it also speaks to the contract type situation that you might run into. The next point would be on selection of successor operators. Again, that's another area that's changed and been modified, I believe, as a result of cases that have come up. In old JOAs, you were required to have 2 or more parties in order to elect a successor. However, the new one only requires a majority interest, one owning a majority interest in order to do that. So last but not least, the access rights of non-consenting parties. Really, and I'll talk a little bit about payout audits there, but what I really want to get at on this non-consenting is before the language really wasn't non-consenting, they used, and you'll see that on the DG&S red line version, they used to use non-operator language instead of non-consenting, and it was confusing because some non-operators consent and some don't. And so the non-consenting language, I think, is a good enhancement that they put into the new model form. And it also addresses the access of to wells and records, limited to consenting parties until the earlier of the recoupment of non-consenting penalty or 2 years after the date of non-consenting operations commenced. So I think what this does in respect to payout audits is that, there's, I guess the big thing I want to highlight is in 2015, you're going to see a lot of companies that went non-consent just because their budgets changed, or they decided, we're not going to spend money on our non-op interests. We're going to hold off. If the operator wants to spend money, that's fine. So there's going to be a lot more non-consent type activity, I believe, from 2015 onward because of pricing. And what I really want to address is that payout audits can happen, and I think they should happen at least 2 years after, and that's the only time you really can start auditing is 2 years after you went non-consent, or you can do it, at the time of payout. But it's just important to audit that because payout can happen. The timing of that payout is going to depend on the costs and the revenues that affected the well and the property. So if there were costs and revenues that were wrong, then you're not going to catch that without the audit. And if they did pay out sooner, then you definitely want to get into that well sooner rather than later if you knew that it paid out. All right, the next area that's kind of new to the industry, and I really wanted to bring this up as a point of reference, especially for the accountants that are on the line, is there is guidance on controllable equipment and materials that is new and going to be helpful to do your jobs and perhaps people in your purchase order, area that they understand the materials and how things flow. So materials pricing manual is MFI 38, and it was approved by Council of Petroleum Accountants Society last year. It provides a lot of information, kind of comprehensive set of information to help you with your materials. In the 2005 accounting procedure, I'm just going to kind of talk a little bit about how materials kind of move and the risk to the operator and non-operator. But in a rising market, the operator pockets the gain, and in a falling market, the operator has no incentive to dispose of materials and take the entire hit. Some companies revise the form so that material is repriced so that both operator and non-operator share in the gain and loss. So, just something to keep in mind in terms of forms are out there and they may be specific, but if you need to revise or you need to amend your form, that's also something that can be done in terms of materials and how things get handled. But with respect to pricing in general, the newly approved model form interpretation 38, there was a time, I think, that people were not following the accounting procedure, and they would charge materials based on historic cost, average inventory, the average price. And really, at the end of the day, what goes up must come down. Eventually you have to write down the material, and non-operators, they'll want to reprice the material when the accounting procedure method is lower than the historical cost or the average price. And so really kind of a solution to this area would be the SEP's computerized equipment pricing system. COPAS offers this, and it's something that's updated consistently based on market conditions. It's also something that can support your pricing and your material movements. And there is a COPAS SEP's control panel who watches over, monitors this. Every quarter they get together, or even more frequently if there is fluctuations happening. So that's a tool that's available through COPAS that you can look at. Operators are trying to also use more surplus materials rather than spending cash in order to get new items. So material pricing, reconditioning costs, and the rules on disposition are all important when these types of activities are happening. Where you can find this is through the COPAS e-publications. And really I wanted to highlight that in 2016, COPAS is waiving the initiation fee for the COPAS e-publications. Generally, you have to pay a lot more the first time you access or buy it, and then you have an annual licensing fee beyond that. But this year, that initiation fee has been waived just to encourage people to get this, because it's got all of the publications, not just this materials manual. There's, for example, Accounting Guideline 24, which helps guide you on your AFE procedures and how the balloting goes with AFEs. Also, when you're trying to include overhead costs in your AFEs and how to recover costs, it addresses all of these things. AG 23, which is a guideline on overhead negotiations and calculation. I see a lot in our practice that people or companies choose an overhead rate just because the operator next door has the same overhead rate. It's really important that each operator really look at their overhead rate and figure out what that rate should be, not based on the old operator or what was going on in the field right next door to your field. It really should be looked at from the terms of an accountant and looking at your true costs to operate, so that you can really come up with a good overhead rate, especially if you're going forward and creating new joint operating agreements. There's also some information about technical labor, what's billable, what's not. So again, there's a vast amount of information out there in the e-publications, and there's searchability there. There's ways to kind of look at things so you don't have to read it from front to back, but it's out there. It's a tool, it's a resource. If you don't have it in your company, get it, because it's going to help a lot in terms of what you're doing and making sure it's done correctly. And then another area that your staff or yourselves might be interested in is the new educational opportunities that are available through COPAS. There's a few seminars coming up that one will be in Shreveport next week on the 25th. It's going to be Joint Interest Accounting Stories from the Trenches. In Houston on May 10th, there's going to be a Joint Interest Audit. Corpus Christi on May 12th, there's going to be Joint Interest Accounting. In Houston on June 20th, there is going to be a gas balancing, and then again in Houston from August 21st to the 24th, there's going to be building your fundamentals in oil and gas accounting. So there's a lot of kind of live sessions that are out there, but there's also going to be some webinars that are going to be offered through COPAS Energy Education. And the other really cool thing that I think you need to be aware of, because it's brand new, is the COPAS established the Educational Foundation. It's a 501c3, so individuals and companies can donate to that foundation and help keep this education rolling, and specifically to accountants doing the work. This is so valuable and important that we get the knowledge transferred from the other generations to the new generations coming up, and really kind of keep our companies aligned and understanding what the rules and the industry guidelines are in our accounting practices.
Okay, and now it's time for our third polling question. In 2016, COPAS approved a materials manual document available via COPAS e-publications that addresses the various aspects of accounting for materials in the oil and gas industry. True or false?
All right, looks like everybody is on board, and we got 100% there being true. People are paying attention, so that's good. So to our practice area, and kind of more specifically what we do here at Hine in the cost recovery area for joint operating agreements, non-operators, operators, that sort of thing. We had a webinar last December, and we have it online, and it's available. And I'll cover that in another slide so you have the link to it. But I'd encourage you to take a look at that, because it really goes more in depth in terms of what can happen on the cost recovery environment. But this slide really kind of highlights what our downs have been really in the last few decades, and from the 70s on to the 2010s, or 2016 is really the last big downturn or big down price. We all have felt it and experienced it. We have our companies, are reacting to that. We're seeing that every day. So it's, the price environment, really kind of promotes that thought process of, hey, we might have some costs that we can recover here, but I think it really becomes an issue when companies don't think about this until the price tanks. I mean, it should be something that is thought about even in the up times, because that's where the money's getting spent. That's when people have money to be able to recover. And sometimes you're stuck when it gets to the downturn because of bankruptcies or what have you, and things get held up, and you can't get the money quite as readily or as capably. So, just kind of think about it. Every decade there's going to be swings in this commodity. We've got to, I think, do a better job as accountants and as stewards to look at our expenditure side and look at our revenue side as well, to make sure that things are being handled appropriately. So in our practice area, the concerns that we've kind of run across that are highlighted on this slide are quite a few, and they do add up, but the dollars have come to be pretty significant for our clients. The cost of drilling a well has not declined, and definitely has not declined as much as the price of oil in this recent downturn. It continues to be a big contributor to the economics of the well. So operators are looking for ways to recover their costs and things they might have missed. So discussion, or if you look at MFI 40, which is your 24-month adjustment period, Model Form Interpretation 40, talks about what you're able to adjust as an operator over the last 24 months, as well as kind of that whole audit right component. So as an operator, if there are some things that you might have missed and you didn't bill out, you still have time to do that back to 2015 at this point. Now that we're in 2017, it's the 24 months preceding the current year. So January of 2015 through December of 2016 is available for adjustment. Rig cancellation costs, that might be something some of your companies are experiencing because of dead time or suspensions. Model Form Interpretation 56 talks about rig-related costs and how do you handle those downtimes and suspensions. Shared well pad costs. If a well is delayed, how do you do the well pad cost reallocation? And, you know, the 24-month window, how do you kind of factor that in? A lot of companies do what's like a pooling methodology where they pull the costs and they've got the information and the backup for where the costs came from and how those were allocated and reallocated. But the shared well pad AG 29 really does a good job of helping discern how one might handle these costs. And then canceled projects. You know, what do you do if you have a canceled project? Again, the e-publications are going to help you answer these questions. I'm not here to tell you the answers today. I'm just here to guide you to the resources in which you can go to and that are available to help you get your questions answered. Some other areas that you can, you know, what areas you could go to is going to meetings. You know, the Joint Interest Audit Committee meets every month from September through, their last meeting was in April. There is an Education Day coming up where they're going to cover a number of topics, especially with the downturn. So you're going to get some good information in COPAS Colorado's Education Day in May, and that's on their website, copas-colorado.org. A lot of information is out there, and the only way that I've really personally gotten to understand this industry and learn about it is exposing myself to those opportunities. So I just encourage you to seek those opportunities out wherever you can. Now under general concerns, when we're going out to do an audit, there's a number of procedures that we conduct, and those include reconciling. We try to reconcile all of the overhead and find whether or not there's wells or there's concerns in terms of how our clients have been billed overhead. And it's a comprehensive kind of process that allows those exceptions to come to light and for us to be able to provide that information to the client in a comprehensive fashion is helpful. Allocations. If you're an operator, it's really important to have the basis of your allocations documented and documented fully, and the support information. Journal entries just aren't enough. It needs to be more than just a journal entry. There needs to be a basis. There needs to be some source documentation that's really promoting that allocation and a very good understanding of how that allocation came about. And then joint interest billings are a consistent process for most operators, but looking at how you're jibbing out costs and when you're jibbing those out, you know, be it quarterly or annually in some cases, just having good support and information is helpful. So that highlights that need for charge support. Just keep that in mind. Just the more documentation effort you can put behind that charge, I think you're going to find the easier life will be on the side of your accounting group and the side of what's going on. And then personnel. We've run across some personnel who are trying to address the auditor requests and maybe aren't in a place or a position that really have a good understanding of what they're addressing, or how to address it. So I think who do you choose to address these requests is really important. I guess it's okay to have someone in place to kind of point to find out who those people should be, but it really probably isn't always going to be the same person that's going to have to address those requests or those questions. So, you know, just having a really good understanding of who that is and instead of just maybe making up some answers or answers to the request would be much better. to come from the right person and the right source within your organization. Knowledge gap, we've seen a lot of personnel that just don't understand what is recommended in the industry best practices, or what should be done and why. And again, that just goes back to education. It really points to the need to get our people educated, get the information in front of them, even maybe do roundtables within your organization to kind of go through some things, some current issues, topics. We help in our service line. We always like to talk to our clients about specific issues that might be a concern, what we're seeing, and how they may address it, and how COPAS handles it. So it's a good thing, and I believe people need to really tap into that expertise more. The policies, on the accounting policies, I think we see those misalign with the joint operating agreement a lot, because there's various joint operating agreements in place, different years, different assets that operators have. And at the end of the day, the operator really wants to just get a reasonable policy and procedure going with their accounting group. And that reasonable policy and procedure may not align with the JOA. And in some cases, you know, they basically point to, hey, it costs us more to align it to these specific one-offs than it would for us to just keep a consistent practice. And that's where the joint interest audit protocol and procedure and having that consistent practice comes into play, because if your JOA is different than the latest and greatest or the new one, or you know, maybe there's a lot of modifications going on in your joint operating agreement, it's very likely that the accounting is not aligned, because the accounting is being done so that it's consistent, that it's processed on a regular basis, and they're willing to take that risk that there's going to be an audit finding, and that audit finding maybe is going to be recurring. It's going to happen every time you go and audit them, because they're just not going to change their practice or their process to do the one-off accounting procedures that are out there. So keep that in mind. And then building relationships with the operator and the non-operator, we find that relationship building occurs a lot better when you're communicating consistently with your operator, and when that information is available, you know, in terms of exceptions or issues or perhaps amendments to your agreement in order to really align with what the intent is for that operator non-operator relationship. That relationship is, I think, really critical, and our practice does a really good job of understanding what that relationship is. We don't want to go in there and cause problems or harm to that relationship. Our intent really is to align with our clients and make sure that that relationship stability is maintained and enhanced as a result. So non-operators are anticipating to continue exercising those audit rights and find recoveries. In only recourse that non-operators have is through the JIB audit or the revenue audit process. They, according to the joint operating agreement, have to pay their bills. They can't just not pay their bills. So that's why the joint interest audit is in place, is to be able to look at those records and make sure that everything lines up and is accurate. They can't do that on a monthly basis or nothing would get done. Operator would never get anything done. So every 2 years, the non-operator can go in accordance with the JOA to look at those charges and make sure they're right. And the non-operator should know what their audit rights are and exercise those rights. The operator, you know, on that end should really have preparation in place, you know, by doing self-audits, self-desk audits, taking a look at what their procedures and processes are on the reconciliations, their tubulars, their overhead, what are their billing procedures, taking a consistent look at those things, material pricing, documentation supporting their charges, especially with insurance. We're seeing a lot more insurance issues out there, the equipment, the allocations, and then vendor audits is another area that you can do as an operator that's gonna benefit you and your joint account if you find things there. And that should be consistent practice. I know a lot of operators already do that, but it's definitely something that I see as something consistent that can be done and find recoveries. And it also, at the end of the day, will help increase your non-operators' confidence in your accounting practices if you're doing these things and kind of truing up what the activity is and making sure the bills are accurate. And then, at the end of the day, when you're going in to audit these non-operators, just making sure that you have consultants that understand the business and understand the industry when they look at the oil and gas industry and they go into the operator and they really facilitate what the client needs and what the drive is behind that audit, because you can have different objectives for your audit. It doesn't always have to be the same. So really just communicate with your consultants. Know that it's a long-term type of proposition so that you can continually have oversight and diligence into your agreements and what's happening. And this slide really gives you the link of where you can go to look at the presentation from last month, or last year actually, at the end of the year. And it's relatively recent. It really goes more in depth into our audit practice and what we've seen and what our recommendations are. So, take a look at that link as well.
Okay, and our next polling question, does the new 2015 Model Form JOA affect the COPAS accounting procedures significantly? Yes or no? Okay, so this one's not quite as cut and dry as the previous answers. We have 35% are saying yes and 62% are saying no.
Okay. And, at the end of the day, this new model form JOA, which the AAPL brought out, it really doesn't affect the accounting procedure significantly. The only way the accounting procedure is really going to be impacted is if COPAS goes in there and actually rewrites it. The 2005 accounting procedure for, onshore is what is the effective procedure today. It does do a better job of aligning definitions with 2005, the new JOA does, but it really doesn't impact the accounting procedure significantly. So marrying definitions, I think that's one of the big takeaways, is there were definitions established in the 2005 accounting procedure, and those were not really evident in the old model form JOA. They are a lot better aligned now. And also more updates to the division of interest, that Exhibit A, which we talked about, there's a mechanism now in place to keep that updated. The new comprehensive guidance on controllable equipment, we talked about that, and then cost recovery capabilities. But thinking back to the idea of finding extra money, be it in your spring cleaning projects, your pocket of your jacket, or maybe a payment you received in the mail, consider what happened in order for that money to be found. Did you know you had that extra money? Wasn't it nice when the money showed up unexpectedly? What sort of considerations did you have going through your mind when spending that money? So if you didn't do that spring cleaning project, if you didn't check that jacket pocket, if you ignored your mail, then this money might have been missed, and the opportunity to have that extra spending money may have gone by the wayside. The same goes with the audit process for a business. Those companies who implement the so-called spring cleaning initiative will find money they didn't know they had, and they'll reap the benefits of spending that money on the requirements of the business. Not only will they find dated recoveries, they may save their company a lot of money in the future by flagging issues and ensuring the operations are conducted properly going forward. Or at the very least, knowing what the issues are, so that in that initiative, they can establish some of that finding every year. So, hopefully you consider the impacts of these new joint operating agreements, how they may be able to facilitate better operations going forward, how they address your horizontal drilling program, and, find out ways in which you can better save your company money going forward into the future.
And our last polling question, joint interest audits are the primary avenue that non-operators have to verify that payments made to the operator were accurate and appropriate, since the JOA requires consistent payment of JIBs by non-operators in the course of normal business. True or false? And it looks like the overwhelming response on this one was true.
That's right.
So now we'll go ahead and move into the Q&A portion of our session. So if you have any questions, please use the chat feature on the lower left-hand side of your screen if you have any questions to submit. Okay, first question, how would our company go about conducting a desk audit?
Well, I think each company is going to be a little unique and different in what a desk audit means to you. So if you're a company that has primarily non-ops, that would involve kind of taking a look at the JIBs and taking a look at your 8/8 activity in the well, maybe involving some operational folks to get an idea of, what they're anticipating in terms of the drilling and completion activity and the AFE of the activity if you're looking at drilling and completion, or looking at outliers on your LOE, your lease operating expenses. On the side of an operator, it would be a little different. It would be more looking at your reconciling process in terms of tubulars, your overhead. On the non-op, you could also do a reconciling procedure on overhead, but there's a number of things you can do internally from a desk perspective to kind of get those outliers to identify where your issues might be in your company and internally within the organization. And you can learn a lot by doing so.
Okay, so our next question, what is the normal time frame for an audit procedure on a 2-year schedule from a non-op point of view?
Okay, from a non-op point of view, you really want to kind of notify your operator at least 6 months is kind of the recommendation in advance of doing an audit, or even longer if you can. So for example, if you wanted to audit 2015 costs in 2017, you probably want to notify your operator back in 2016 just so that they have an idea and they can give you a schedule and some windows of opportunity to conduct those audits. So the sooner that you can notify the operator, the better.
Okay, next question. And I'm sorry if I mess up, there are a lot of acronyms in this one. What do you do if your JOA is old and the AGs are outdated? Can you update to the MFIs, or are you already required to use MFIs as the current accepted practice?
you would have to use the MFIs as the current accepted practice only because you don't have an amended agreement. The only other way to get around that issue is to get an amended joint operating agreement. So the JOA needs to be amended in order for new model form interpretations to be in place, unless that model form interpretation really speaks to the specific publication or the specific exhibit that you're looking at. So it really depends, I guess, is the answer to that question. If the MFI does address your specific document, then it would be relevant. If it doesn't, you've got to go look for one that does, or figure out a good, valid answer based on the joint operating agreement language itself. So.
Okay, and I think we'll try to fit in one last question. What due diligence activities would you recommend when purchasing properties? Royalty payments were made in compliance with the lease terms, or verify deductions are properly classified? Sorry. Oh, I think I may have combined the questions. I'm sorry. So, okay. Yeah, royalty payments were made in compliance with the lease terms.
Okay, so due diligence, effectively, if you're buying a property, if that's what you're alluding to, is purchasing the property, is trying to get that seller to make sure those audit rights are still in play for you, so that you can go and take a look at those if that operator hasn't already conducted an audit. It's important to get the audit rights established and get it in writing. Make sure your legal team is involved in that so that you can go back and look at those royalty payments and make sure those are correct. But in the due diligence side of things, I mean, you can kind of look at it tertiary, but you're not really going to know unless you're in the operator and looking at the true transactions that are underlying them. So that would be through the audit process. And again, we've had clients that have gotten audit rights in the acquisition process that make sure that they can go back and look at those things because they now own the assets, and whatever recoveries that they get as a result of that get to go to the buyer rather than the seller. So they kind of basically, the seller says, okay, you can go ahead and audit and you can have whatever you find. And that's kind of the rights that are given in some cases, that you have to get the seller to agree.
Okay. So actually, I looked at the clock incorrectly, and we do have a little bit more time, and we have a couple more questions. What happens when a large company operator refuses to respond to audit exceptions? How is that handled in the real world?
Well, in the real world, it's got to be, legal sometimes, unfortunately. If they're sitting on these audit exceptions and they do not respond in the manner in which they should be, which is basically providing support and evidence to support their claim if they are denying any of these exceptions, that evidence should be available to you. If you're not getting anywhere and you're not even getting a response, then I think you need to bring legal into the picture and talk about your avenues for getting this settled and addressed in a arbitration or mediation type situation. And it, the end of the day could be in the courts. So.
Okay, and one more question. With horizontal multi-stage fracked wells, the rig may move off during the frack, and a rig may be brought back to drill out and put well on flow back, then move off again while production testing may continue for a couple of weeks. When does the drilling overhead rate stop?
So the drilling overhead versus the producing overhead, that's a good question, because it is in this scenario, it appears that you're still undergoing drilling activity. However, the joint operating agreement and the specific, when is it a well producing, I think you need to go back to the definition of when a well is producing. Is it during flowback, and does the agreement determine that? That's what's going to drive your decision whether or not you can bill out overhead as producing, or you can bill out overhead as drilling and completion activity. And I would kind of if it's a gray area and you can't really determine it by any of the information that's available to you, I would document specifically what the thought process is when you do bill it out, in terms of why you're billing it out maybe at the higher rate, and maybe even get agreement by the partners that that's reasonable and accurate in terms of what they would anticipate. So.
Okay. Next question. We have a major company operator who charged a full month's worth of drilling overhead for workover AFE that probably took only 4 to 5 days. Can I ask them for the daily workover reports directly from them?
Yes. They should be able to provide all of their books and records that go with the drilling and activity of your well. So, yes.
Wow, that's a short one. Okay, next question. I'm an operator that is buying properties from an existing owner-operator. What type of due diligence activities can be performed to ensure royalty payments and deductions were proper prior to purchase?
Yeah, that's a really good question. And I think that the best thing you can do is really get a good audit firm to go in there and look at what their process is with respect to the specific properties and the specific agreements in place. So, it would be worthwhile to really kind of do a deep dive as if you were a non-operator, going into that operator and looking at that agreement and seeing if there are any qualifying concerns that you might have, because the statute of limitations on royalties is a lot greater than the than your limitations on expenditure audits. So your exposure could be pretty good when it comes to royalties. And if you don't know what that potential exposure is, then you wouldn't know how to quantify, in the acquisition of that property very well. So you really wouldn't know unless you did a deep dive.
Okay, next question. Do you have any insights on where North Dakota as a state is moving to handle the rising disputes among companies due to the lack of JOAs and COPAS accounting agreements?
I personally don't, but I know that it's an issue. And I know that we've audited properties that did not have a JOA in place, because statute basically allows these operators to go in and operate. And I think a lot of the reason we don't see the JOAs is because the penalty for non-consent is a lot higher, whereas the statute is less, so you can kind of back into your wells a lot quicker as a non-JOA participant. So there's a lot of kind of, twisting of arms out there. They're trying to get non-operators to sign these JOAs. A lot of non-operators have issues and problems with the JOAs because they may be really favorable to the operator and they're not getting the negotiations they want. So I think it's, not going to be answered here in the near term. That's kind of my feel on that. So.
Okay, well, thank you, Deanna. That's all the time we have for questions. Please check your inbox for a follow-up email with an evaluation form that must be submitted in order to receive your CPE certificate for the course. Thank you again for attending, and have a great day.